Breaking news from the Federal Reserve today has sent shockwaves through financial markets. The Fed is now signaling a potential 50 basis point rate cut, that's 0.5%, coming as early as next month. This is significant because just weeks ago, officials were talking about keeping rates steady. The dramatic shift reflects growing recession fears gripping the economy. Stock markets have reacted with confusion and concern. The S&P 500 is down roughly 2% today alone. But what does this actually mean for your savings account, your investments, and your financial future? Let's break it down. First, let's clarify what a rate cut actually is. The Federal Reserve controls the federal funds rate, the interest rate at which banks lend money to each other overnight. This benchmark rate influences virtually every other interest rate in the economy, from mortgage rates to savings account yields. When the Fed cuts rates by 50 basis points, it's essentially making borrowing cheaper and saving less rewarding. The Fed implements cuts during economic uncertainty to stimulate spending and investment. Lower rates encourage consumers and businesses to borrow and spend money, theoretically boosting economic activity. However, they also reduce returns on savings accounts and bonds, directly impacting savers. The Fed doesn't cut rates casually. When they're signaling a 50 basis point cut, it's because economic data is raising red flags. Recession fears stem from several concerning indicators. Job growth has slowed dramatically in recent months. Consumer spending is weakening as inflation erodes purchasing power. Corporate earnings are declining while debt levels remain elevated. Credit markets are showing signs of stress. The yield curve, a key recession indicator, has inverted multiple times this year. Historically, yield curve inversions precede recessions by 6 to 18 months. The Fed is essentially saying they see economic storm clouds gathering and want to preempt a potential downturn. They're acting defensively. You might wonder why markets are down if the Fed is cutting rates. Isn't cheaper borrowing supposed to be positive? The answer reveals a crucial market psychology principle. Stock investors typically interpret rate cuts as confirmation of economic weakness, not as good news. A rate cut signals danger, not opportunity. The 2% S&P 500 decline reflects this fear. Markets are essentially saying, if the Fed needs to cut rates this aggressively, the economy must be in worse shape than we thought. This creates a self-reinforcing cycle of pessimism. Investors sell stocks, which drives prices down further, which increases fear, which prompts more selling. The rate cut itself isn't bad. The recession it implies is what frightens markets. Now, the personal question, what happens to your savings account? If you have money in a high-yield savings account currently earning 4 to 5% annually, expect that rate to drop significantly. Banks reduce savings rates when the Fed cuts its benchmark rate. Within weeks of a rate cut, your savings yield could fall to 2 or 3%. This directly reduces your purchasing power over time. Money market accounts will face similar pressure. Even treasury bills and bonds will offer lower yields. If you were planning to earn returns on cash reserves, those plans need adjustment. The silver lining. If you're carrying variable rate debt like credit cards or adjustable rate mortgages, those rates might decrease too. But for savers, rate cuts are generally painful. If you have investment portfolios with stocks and bonds, prepare for volatility. Lower interest rates theoretically benefit long-term stock valuations because future earnings become more valuable in today's dollars. However, recession fears typically outweigh this benefit in the short term. Stocks will likely remain under pressure. Bonds might rally because their fixed payments become more attractive when new bond yields drop. A balanced portfolio might weather this storm better than pure stock portfolios. Dividend-paying stocks could become more attractive to income-focused investors seeking yield. Real estate investment trusts might benefit from lower mortgage rates, but could suffer if recession actually hits property values. The key strategy during uncertainty: diversification becomes critical. Don't have all eggs in one basket. Action steps for your financial situation. First, audit your savings rate. If you're earning less than 2% on savings, shop for banks offering higher yields before rates drop further. Second, review your debt. If you have variable rate debt, consider locking in fixed rates while they're available. Third, assess your investment allocations. Are you positioned for a recession? Consider reducing stock concentration if you can't weather a 20 to 30% decline. Fourth, build cash reserves. Economic downturns create opportunities for those with cash to deploy. Fifth, Don't panic sell. Market timing is nearly impossible. Historically, staying invested through downturns outperforms selling and missing the recovery. Sixth, consult a financial advisor if significant assets are at stake. Professional guidance becomes valuable during uncertainty. The next month will be crucial. We'll see if the Fed actually delivers that 50 basis point cut or adjusts based on new economic data. Watch for employment reports, inflation data, and corporate earnings guidance. These will determine whether the Fed follows through. If recession becomes reality, more rate cuts will likely follow. If the economy stabilizes, the Fed might pause. Your financial success depends on preparation, not prediction. Build resilience into your financial life. Maintain emergency reserves. Diversify investments. Stay informed, but avoid obsessive market watching. Remember, economic cycles are normal. Recessions happen, market downturns happen. But historically, patient investors who stayed the course prospered. The uncertainty